Hi, I'm Chad Griffiths, and I'm excited to have the second season of my interviews with industry experts. And my first guest for this year will be Kevin Gardner, who's a mortgage professional with Canada ICI. He's been involved in a number of different transactions, and he really is an expert in financing for real estate for all different asset classes. Focus of my channel is predominantly industrial real estate, so we do get into industrial as well, but we try to keep it a very broad conversation about the different elements of getting financing, what you can expect, how the market's shifted over the last year or so. And we really did have an awesome conversation just around commercial real estate in general. I'm sure you'll get some value from listening to Kevin's insights, and look forward to sharing this with you. Hey, Kevin, thanks so much for joining me on the show.
Thanks, Chad. Glad to be here, man. Appreciate the invite.
Yeah, so I really want to get your thoughts on a number of different topics, because I know you're deeply entrenched in the commercial and industrial real estate market on the finance side. So the first topic that I want to bring up is a conversation that I heard a lot at the beginning of this year from people that were involved in receiverships. And I heard this from a few different accountants, is they thought this was going to be the Superbowl of receiverships this year, with a ton of properties going into foreclosure and ultimately going through the receivership process. But I haven't really seen that myself. So I wanted to get your thoughts on what you've seen in that process, but also kind of a two-part question, because I also want to get your thoughts on what you're hearing from lenders on their comfort level to deploy capital, as well as the people that are actually borrowing it, on how comfortable they feel accessing it right now.
Yeah, great question. I think start of COVID, there was a lot of unknowns, not only from the ownership side, but from the lending side. The government, as you know, stepped in right away to provide a lot of resources for landlords and for business owners, and most took advantage of it. From the lending side of things, lenders were very, very quick to provide mortgage deferrals, either full principal and interest payments or merely principal payments, and that went a long way. From our side, we did expect more trepidation come into 2021 with properties, especially on the retail sector, given the forced closure of a lot of businesses. And we weren't necessarily surprised that the lenders stepped in and did what they did to help the businesses and the borrowers. What I was a little bit surprised with was how quickly businesses have been able to bounce back for the most part, and continuing to work with their lenders to find sort of a win-win solution to help the landlords out, but also help the businesses out. So we did forecast some foreclosures coming into 2021, especially in the retail sector, but we have not seen that. And I think it's just merely government subsidies, as well as the lenders looking at their balance sheet, realizing that they don't want to be owners of assets, and working with their landlords to try to find a win-win solution.
So does that essentially kick the can down the road with all this government stimulus that's come in? Is this a problem that perhaps doesn't manifest until later 2021 or 2022?
I think it's, I would like your thoughts on that, but I think as long as the businesses can get back and up and running full steam ahead, then for the most part that they should be okay. I think from the lending side of things, come annual review time, when the lenders have to look at the annual review, look at the rent rolls, see who's paying rent, see who's not paying rent. There might be some issues from that side of things, but the good news is for that forced closure retail sector, traditionally in these properties, there's multiple tenants and it's not a single tenant property. So from a lender standpoint, they have multiple different income sources typically that they can rely upon to service the debt payment, and are willing to work with landlords if the landlord has some issues with maybe one or two tenants. So does this get kicked down the road? I don't think so. I think the lower interest rates have also helped a lot of landlords in the near term. And, there's a conversation around where does the interest rates look like going forward, but that's probably a different conversation.
Well, and maybe we jump into that as well, because I don't think anyone has a crystal ball, but that seems to be the question on everyone's mind right now, is when inflation does go, or interest rates go up. But before we get to that, I want to explore that one topic a bit more from an underwriting standpoint. How are lenders looking at properties? And retail is the natural one, because there's a lot of companies that were forced to close, as you mentioned. But I think office is another challenging one, where a lot of people just weren't working. A lot of companies are trying to reconfigure and project how much office space they're even going to need going forward. And even on the industrial side, that's been a strength in this market, but there's still companies that struggled in that regard. So how are lenders looking at a property that perhaps has vacancy coming up, and maybe they've had to defer some mortgage payments, maybe some of the tenants were delinquent? Are they recalculating how they assess the risk profile on a building that has had challenges over the last 18 months or so?
I think they will assess the risk profile of the assets if there has been a material change in the rent roll and a material change in the lease rate. Because if there's a material change, say for example, a landlord's working with a tenant, and the tenant says, you know what, I can't, I will continue to pay rent, but at $15 a square foot versus 25. Maybe the landlord wants to do that deal. The challenge from the lending side of things is that if that deal gets done, then the value that they lent on originally is not the same value. And so you're going to get sort of into a loan to value issue with lenders, that come annual review and come maturity date of the loan, maybe that loan looks a little bit different when that time period comes up. What I would say is that what's been interesting in 2020 and into 2021 is that some lenders have, retail, for example, is just a no-fly zone. Depending on, notwithstanding, there might be a lot of strength to the deal from a borrower landlord side of things, and also a strength from the tenant side of things. The lenders have implemented a policy that going forward, we're just going to take a pause on retail. That becomes an opportunity for a lot of other lenders to step up and take some market share, given they understand the risk profile of the deal and they're not scared of retail. Now, I would say that what I've seen from the lending side of things is that there is a focus on, there is greater underwriting done to the quality of tenants, length of leases, the rent per square foot that they're paying versus what the market would be. And then also the strength of the landlord slash borrower and the corporately as well as personally. And so what I mean by that is that a lender looks at a deal and they say, yeah, we like the profile of the building. You have got a couple of tenants that in our view, the lender's view, are marginal and may or may not make it. However, you as a borrower, you as a guarantor are very strong. So if there is something that happens with those tenants, then the borrower slash guarantor can come in and solve that problem with cash, and has the ability to service debt on the building personally or corporately, should something happen with the tenancy and should something happen with the income profile.
So are you finding that that's make it more challenging to put together maybe those fringe deals, maybe where the investor isn't as strong as a high profile investor, but kind of on that fringe, and maybe the company isn't as strong? Is it challenging getting access to capital right now, or is there capital ready to be deployed?
I think if you don't have a lot of experience owning assets, and you can come up with the down payment to acquire an asset, but maybe don't have a lot of liquidity above and beyond that down payment, then I think there's going to be less lenders that are interested in doing that deal. Absolutely. But however, to your point, if there is some vacancy within an asset and you are a sophisticated investor and have a plan in place to deal with that asset and deal with that vacancy, then there's a solution from the lending side.
Are you finding it's taking longer to go through the underwriting process right now than it was 18 months ago?
Absolutely. It's probably similar to some of your lease deals that you're doing, Chad, where everything's just taking longer. And I think I know that for the most part, vendors are mindful of that.
Yep.
And deals are still getting done, but I would extrapolate your traditional due diligence phase longer than 30 days into the 45. We can get deals done in 30 days. However, I think it would be very, very common for that due diligence period to be extrapolated out to 45 days at minimum for extra due diligence that needs to be done on assets. Absolutely.
And would you say that that's 45 days from having all reports, or is that kind of running in tandem where they're going to start the process and as reports come in, they'll incorporate that into the process?
I think the 45 days can start once the PSA is executed.
Okay.
Yeah, absolutely.
Yeah, and I agree. We're seeing the same thing. It's just taken a lot longer to get things done. There's just more scrutiny, as you mentioned, and just the process just takes that much longer. So yeah, I agree. It has slowed down. Hopefully that speeds up as we come into the fall here. But I agree. It is slow right now. One question that came to mind as you were going through that, and I don't know if you even have an answer for this, but are lenders probing deeper into the tenants that are occupying the space? Like, are they trying to get financial statements from the tenant, even knowing that that's very difficult to get? But how much more scrutiny is going into, like, call it a small mom and pop company that's occupying the building versus a known brand name? How can they give themselves comfort knowing that that tenant is able to pay their bills?
That's a great question. If the lender's relying on one income source to service the debt payment, then traditionally they would want further comfort through financial statements that the tenant has the ability to be able to make their rent payment. However, for the mom and pop business, if the lender can rely upon the income from the mom and pop and also from additional income sources that is within the asset, then the lender has our financial statements from that mom and pop.
Yeah, that makes sense.
I think it basically comes back down to the risk profile in the deal.
Yeah.
And from our side of things, the lender is the borrower or the landlord's biggest investor in this deal, right? The landlord or the borrower is putting in some equity to do the deal, and the lender is also a partner and putting in money into the deal. So if you look at it from that perspective, the lender is going to be asking the same questions, or should be asking the same questions, that the person acquiring the asset, or the person owns the asset. So it really is a partnership. And if it's viewed like that versus the lender in its own silo, then I think both vendors, landlords, and lenders will have a more successful relationship and transaction.
I think that's a great way of describing it as a partnership, because it really isn't just I'm on one side and you're on the other side, and we're trying to go after different things. Collectively, you're trying to accomplish the same things. So I like that idea of calling it a partnership.
And the lender doesn't want any ownership stake in the property. They merely want to earn a small return on their investment.
Yep.
Right. That's all they want. And the sooner that we can view it that way, and the sooner that we can work with the lender to solve any issues and get ahead of it, lenders actually appreciate it. They want to be a part of the solution versus being part of the problem, I guess, or a problem coming to them when they didn't expect it. That's when lenders sort of get their backs up, and you can get into some serious issues.
Yeah, they certainly don't want to be kept in the dark on it.
Yeah, absolutely. And so I'd be curious from your standpoint, if you're into 2020 and 2021, if you've seen more foreclosure work in your business, and what that looks like for you come tail end of 2021 to 2022, if you foresee some more foreclosure activity.
Yeah, I expected a lot of foreclosures in 2020. But when this all started unraveling in March, I think it was like mid-March when the NBA shut down the season. And like I was legitimately panicked. Not just for like all the clients, but for myself and my investments. I legitimately thought that the world was going to come to a financial collapse. And what blew my mind is that you can never underestimate how much money the government is going to spend to solve a problem. That was the one thing that became very clear to me, is that there is no off button. They would just keep spending as much as they had to keep the wheels from falling off. And I noticed that coming from like June and July of 2020 all the way through to where we stand right now, is that they're continuing to announce new stimulus, new programs, flushing the system with cash. I think this creates a different problem down the road, and we're starting to see elements of it right now with inflation and with lumber shooting up to crazy highs a while ago. So I think this will cause problems down the road that I don't think anyone can project accurately. Just to know that you can't inject 15 or 20% in new money into the money supply and not expect there to be some kind of issue down the road. But I've been astonished at how much money the government has spent, and equally how effective it's been, because we haven't seen many foreclosures other than properties that likely would have went into foreclosure anyways. They were just poorly managed, or there's some issue with it. I think that those properties would have went into it anyways. If anything, all this fresh capital has probably saved some buildings that might have went into foreclosure otherwise. So a fascinating time. I really don't know. It's but to answer your question directly, I haven't seen a whole lot of it.
And I think that the robust housing market has surprised me. I don't think I'm exaggerating, but I don't think you can buy a used car right now.
Yeah.
Right. So a lot of what nobody has a crystal ball. I would say that a lot of what's transpired over the past year and a half is surprising, to say the least.
Yep. On the financing side, what are you seeing right now for interest rates and terms that can be offered? I know it's property dependent and investor dependent, but even just as a range, like assuming you're a good profile as an investor and you've got a good property, what can you secure right now for financing?
Yeah, great question. It really has. I wish there was an easy answer to that, and it really comes down to the ask from the borrower standpoint. And what I mean by that is if you have a REIT, for example, or a high profile borrower landlord that owns multiple properties, has a lot of experience, that's coming in with a lot of cash, yep, and doesn't need a lot of leverage, then the interest rates for that particular transaction are going to be quite low, and you are able to you'll have a whole host of lenders lining up to do that deal. On the flip side is if you have an investor that's a little bit less sophisticated, maybe an asset class that is a little bit not as in favor, let's call it an office building, and you're asking for more leverage than my previous example, then you're going to have less suitors from the lending side coming to the table, and there's going to be a higher cost of capital. So really, it comes to the risk profile of the deal that prices the interest rate that somebody can expect. So it's a little bit of a moving target. We're doing deals in not CMHC improved in the 2% range. We're doing deals not CMHC in the 3% range. So it is a very, very robust market right now. What I would say is that the majority of lenders that we speak to on a daily basis want to do deals and need to get money out, which is a good thing. Mm-hmm. I would also say that from the multifamily financing side of things, I know that CMHC has been an excellent source of capital for a lot of clients, and they're not giving money away, but their interest rates are very, very low in the 1% range. You know, plus or minus a little bit. And so it really comes down to the risk profile. Just when somebody that's buying a building and maybe needs investors to come in to a deal, those investors price the return that they need based on the risk profile of the assets and competing investments that they could put their capital in. The lenders view it no differently. So if it's a sharp deal, expect sharp pricing. What do I mean by a sharp deal? If you have a government tenant on a long-term lease, and that's the only sole income stream that a lender can rely upon, pretty strong deal. If you have a pretty strong deal, lots of lenders that would be interested in the transaction, and low interest rate. If you have a multi-bay industrial property with some tenants on month-to-month leases, some on 1 or 2 year leases, and maybe a couple on 5-year leases, well, the risk profile of that deal has gone up, and hence the interest rate likely will go up, subject to loan request and borrower strength as well, if that makes sense.
Yeah, that's very well said, and I think that there's a lot in there, because you're really sharing a lot of great information on what people need to be looking at a deal before they're even writing in an offer, because we see this all the time where someone will try and tie up a property and they haven't had that conversation with a lender prior to it, and then they go through all these nuances, whether it's how long it takes to do due diligence, like you're saying, or just how their profile or the building will go in it. So I mean, you know that I'm a big fan of yours, and I always try to recommend that people talk to a broker or a lender as quickly in the process as possible, just so they get a better sense of that. Are you still seeing a lot of people do that, or are people still flying by the seat of their pants and coming to you after they've got an offer accepted?
Yeah, great question. I would say it's both. Yep. Because what I've seen in our market, and maybe you've seen the same thing, is that there are not a lot of investment transactions that are happening right now. They're outside of the multifamily sector, retail, industrial, office, there's just not a lot of product trading. Yep. And I talk to investors all the time that say, Kevin, hey, listen, like, are there any deals out there? And I'm doing my best to uncover deals on their behalf. But there's just not a lot of, there is just not a lot of product trading. Owner user, industrial, what have you, that's a little bit of a different asset class. But if you're strictly looking at investment grade real estate, not a lot of trading. And so I think that I know that it's very important to speak to somebody like myself early in the process, just so you're not surprised at the level of financing that's achievable. Because if you expect X loan amount based on what you've received historically, the market's changed since that point. And depending on what the tenant profile and the asset profile looks like, those lending terms might be different today than they were. Well, they are different today than they were a year or two ago. So I absolutely encourage our clients to reach out to us before they've even made an offer. And we simply need a rent roll and operating statements to provide them a pretty good indication within a pretty close range of what they can expect from the financing standpoint and how many lenders might be interested in the deal.
Yeah, a great point. And I've always said that the best real estate acquisitions involve a team, and that could be a broker, a lawyer, accountant, mortgage broker like yourself. The earlier you can have your team lined up to go into the game, I think it's just better for everybody involved. So yeah, you know where I stand on that as well. I do want to wrap up and get your thoughts on the industrial real estate market, because that's predominantly my focus. I spend all my time in industrial real estate, and I know you've got your finger on the pulse of all the different asset classes, but I do really want to get your thoughts on just where you see the industrial market right now, and if you have any thoughts of where it heads into the fall and even into 2022.
Yeah, great question. We did a 200,000 square foot transaction that closed, let's call it a month and a half ago, to a local based investor, a family office, should you say. it was an investment grade transaction, 200,000 square feet. Let's call it, there was 50 tenants within that profile. We had not only a abundance, from my understanding, there was an abundance of investors that were interested, not only from the Edmonton area, but also from the East Coast and the West Coast. Why the investment was viewed favorably was there a couple of items. It was being sold by a life company, and likely the life company had a time horizon that they needed to wrap up in. And why the investment was attractive was that it was, yes, there was a very good return to earn based on the income profile today, but there was also upside given that there was some vacancy in the asset, and the family office had the opportunity and had the infrastructure really to be able to come in and lease that space. What we're seeing in the industrial sector from the investment side is the conversation is less around return, cap rate, and more around replacement cost and value per square foot from that basis. So I think we're going to see a lot of that going forward. What I'm hearing from our clients is that a lot of the tenants are busy, and they are, from the leasing side, we're seeing more deals getting done right now, which is a plus. I'd be curious from your side of things how the single tenant industrial market and the owner user market is shaking out, and are assets being viewed in that market based on a price per square foot basis versus cap rate basis. But from our side, the lending, they call it the beds and sheds. We've all heard it. It truly is a beds and sheds market from the lending side, and I think from the investor side as well, which bodes well for our market. I just wish there was more product being traded right now. But I think to that side of things, a lot of the vendors are, unless you're a pension fund or a life company exiting an asset, a lot of the ma and pa investors don't necessarily know where else to put their capital right now if they were to sell their assets. So that's becoming a little bit of an issue as well.
Yeah, I love the discussion because I couldn't agree with you more. It's very challenging finding good investment opportunities right now in industrial. And in 16 years that I've been doing this, there's always been a spread between what a buyer wants to pay and what a seller wants to get when they sell. But that spread is probably at an all-time high right now, where sellers are just, they feel that they're sitting on an asset that's going to continue outpacing inflation. They're making good returns. They've almost thought of it as being pandemic proof because a lot of these companies still continued working. So it's on that side, a lot of these vendors just, if they do want to sell, they're setting very high prices, and buyers are still having a hard time making sense of those numbers. So I've got a number of investors actively looking for property, and we can't bridge the gap on that price discrepancy. On the owner user side, almost every company that I talk to, whether they're a tenant or whether they own, they want to look for either another property to buy, or they want to buy instead of leasing. And I think that's partly very low interest rates, and then they also just see it as a very stable investment. So there's a lot of money on the sidelines, whether it's owner users or investors. But like you said, it's still difficult finding great opportunities. So I think that will be the challenge for the rest of the year. But if there is a seller that wants to be realistic with their pricing, they'll almost certainly go multiple offer and they'll probably get offers from their friends, neighbors, accountant, lawyer before it even hits the market right now. So it is a challenging part of getting deals done right now, is that not a lot of inventory, and the inventory that is there is priced really high.
Yeah, it's a great point, Chad. And I'm doing a deal right now where a owner is looking to buy their own building that they currently operate in. And we have a lender that's willing to lend 95% of the purchase price.
Wow.
Right? And I would say that that's not considered the norm. But to your point, if companies have cash and they have good balance sheet and income statements, then there are lenders willing to step up to do some pretty interesting things and have companies come into assets and not a lot of capital that's going out the door that doesn't need to affect their business. So that's, you know, you look at that, and if I'm an owner of a business, do I want to deploy? Do I want to own my own asset, or is it better to reinvest in the building? I'm not sure. But if a lender is going to give me almost 100% financing, and I don't have to affect the cash flow of my business, and I can pay less, I can pay less of a mortgage payment than I'm paying in rent. There's something to be said to that conversation, and we're doing deals right now in that space. I think there's an abundance of capital in that space for the right companies. I would not consider it the norm. So, Chad, I don't need you going out to all your clients saying that Kevin Gardner can get 95% financing. Don't do that. So I only bring it up merely as an example that there is a lot of capital chasing deals right now.
Yep. So what's your general takeaway? What are you saying to clients right now that are considering investing, that need to get debt? Do you have a general message on what you expect coming into the fall here, or are you just really treating everything on a case-by-case basis?
Yeah, great question. I would say that the lenders need to get capital out the door.
Yep.
So that generally speaking, that's a good thing. Now, it really comes down to asset by asset, income stream by income stream. We have no problem putting together financing for a fully vacant building for an investor that's not going to be owner occupied. If we can show lenders a path to their debt being repaid, as long as there's a good story, as long as the story is told correctly, then I think that there's going to be an abundance of capital come the fall. I also think it's an interesting opportunity for some local groups that historically maybe haven't been able to get into the market. If there's more product that's going to trade, Chad, come the fall, I think it's an interesting opportunity for some maybe local-based investors to not have to compete with some Eastern-based investors or some Western-based investors, just because they're with what's happening in our energy sector. Alberta is still viewed as a market that is a little bit of a question mark. To your earlier point, what are some of the economic drivers that make people want to come to Alberta? You tell me. Are we getting more footsteps into Alberta and Calgary and into our market? I don't think there's a lot of footsteps coming into our market. Now, how does that change with immigration? I'm not sure. But I think come the fall, lenders are going to be eager to get capital out the door. I would say that it's very, very asset class and deal specific. And you cannot rely upon the underwriting that you've done on deals historically in today's marketplace.
That's a really great message. And I think that really reinforces that investors should be talking to a mortgage professional like yourself, or anyone if they're in a different market, as early in the process as possible, which we probably sound a bit redundant saying that, but I really do think that that's the truth. How could people get in touch with you if they want to have more information, or if they just want to follow along with what you're doing? I know you're active on LinkedIn, so I'll leave your LinkedIn profile in the description below, but any other ways they can get in touch with you?
Yeah, I'm always available on my cell phone, text, and a call. I'm a deal junkie. I love real estate.
Yep.
If you want to talk shop, talk deal, I wake up every morning passionate about trying to structure deals and trying to figure out a way to get deals done. And so if you just want to talk shop, I'm there. LinkedIn's a great resource. I recently had I was recently interviewed and profiled for an article about mixed use developments.
I saw that.
You can check that out on LinkedIn. And I'm an open book. Like if I can help you, I'll let you know. If I can't help you, I'll find somebody like Chad Griffith to help you out. So let's have a conversation. I won't beat around the bush, and just love talking shop.
And I imagine you can either finance deals all over Canada or at least put people in touch in different markets if they're looking.
Absolutely. We're active all across Canada. Our company, Canada ICI, we have offices throughout Canada. We had one of our brokers move out to Victoria. We're active in the Vancouver and the mainland. We're doing deals in BC. We have an office in Calgary, Winnipeg, Toronto. We just opened up an office in Montreal. So we're nationwide. And part of our reason for expanding out east with offices is that we have a lot of investors that need a bigger presence that want to have a bigger presence, and for us to open up offices in these other markets not only provides them comfort that we're invested heavily in these other markets, but also gives them another avenue to get their capital into the marketplace. So we're quite excited with the Montreal. We're quite excited with the Montreal shop opening, and yeah, we're active. I'm personally active all across Canada, and would love to chat about anything you guys are looking at.
Awesome. Well, I'll put your contact information in the description, as well as a link to Canada ICI as well. And I can tell you're a busy guy with your phone and emails.
Oh,
and text,
sorry,
so,
yeah. That's my mistake.
No, I had no problem at all. I really do appreciate you taking the time for this. I value your insights and wisdom, and I'm sure the audience will as well. So thanks again, Kevin. I really do appreciate it.
Yeah, chat anytime. Thanks for having me on.
Okay, let's keep in touch.
Absolutely.
Thanks, Kev. So as you could see, Kevin is a very insightful guy, and he has a lot of wisdom to instill, and I highly recommend him as well. So if you wanted to talk with him more about commercial financing, I'll leave all of his contact information in the description. Really do thank you for watching this. If you want to follow along and see more interviews like this, I've got a number scheduled over the upcoming weeks with some awesome guests just like Kevin. So please consider subscribing if you want to follow along, and thanks for watching. Have a great day.